Many people believe that the financial landscape is a labyrinth of uncertainty, especially when the tides of recession come crashing in. The very mention of the word recession sends shivers down the spines of investors and everyday individuals alike. But what if I told you that within these turbulent economic waters lie assets that stand strong, unwavering, even in the face of a storm? In a world where the financial landscape seems to shift like tides, Jim Rickards has consistently demonstrated a keen understanding of the intricate forces at play. We'll be discussing his unique perspective on the current recession, one that's unlike any other in recent history, and also unearth the top 2 assets that Jim Rickards believes that could stand as pillars of stability in the times of economic turmoil. Welcome to MoneyWise Investor, your trusted source for financial information. Before we dive into the depths of today's video, don't forget to subscribe to our channel and hit that notification bell. You won't want to miss any of our upcoming videos that could hold the key to unlocking your financial prosperity. The year is 2023, and we find ourselves in the midst of a recession that's sending shockwaves through the global economy. What's causing this turbulence? Well, it's a culmination of various factors, but a key player is the shifting role of the US dollar as the world's reserve currency. For decades, the US dollar has enjoyed unrivaled dominance as the global reserve currency, the premier medium of exchange held by central banks and governments worldwide. This exalted status afforded America outsized advantages and influence on the world stage. But today, Rickards sees clear signs that this monopoly is steadily eroding. Years of reckless spending and ballooning national debt have eroded global trust in the once rock-solid dollar. Meanwhile, rival economies led by the BRICS alliance, Brazil, Russia, India, China, and South Africa, stand ready to fill the void left by the dollar's decline. Their expanding economic might give them the leverage to displace the dollar's supremacy. According to Rickards, the BRICS have the muscle to upend the existing monetary order and dethrone the dollar as the dominant reserve currency. For example, in 2022, China and Saudi Arabia agreed to ditch the dollar for yuan and rial in bilateral trade settlements, a move Rickards sees as the tip of the iceberg. If more nations follow suit, it could set off a domino effect, leading to a new multipolar financial system no longer centered solely on the Federal Reserve. This represents an existential threat for American economic dominance. The dollar's unique status has granted the U.S. extraordinary power to shape global affairs to its advantage, from trade partnerships to sanctions enforcement. But if the BRICS coalesce around alternatives, like their own digital currency baskets, the dollar could enter freefall along with America's financial and geopolitical clout. According to Rickards' analysis, this transition is already underway and will likely accelerate in 2023. Years of unprecedented money printing and inflation have made the dollar damage unavoidable. He sees no path for the U.S. to avoid ceding ground financially to the emerging BRICS economies. Their combined strength ensures the dollar's glory days are numbered. If the dollar loses its dominant position as the world's reserve currency, the impacts could be immense. A sharp drop in global dollar demand would cause treasury yields and interest rates to spike as the Fed scrambles to shore up the greenback's value. Prices for everyday imports like food, fuel, clothing, and electronics would skyrocket even further, and dollar-denominated assets like stocks, bonds, and even crypto, all predicted on dollar strength, could sustain immense shocks. In essence, Rickards believes the world is witnessing a bona fide currency crisis in motion. The dollar is facing its most potent threat in modern history from the unified force of the BRICS economies. This brewing currency war between the dominant dollar and the rising BRICS spells volatility for all markets in 2023 and beyond. Central banks are ramping up interest rates to tame inflation, but this will increase borrowing costs for consumers and businesses. Housing markets already show signs of buckling under the strain. Supply chain disruptions still persist due to China's zero-COVID policy and the war in Ukraine. Food and energy price shocks are squeezing household budgets to the breaking point, and the stock market sits on the precipice of a steep correction after the Fed fueled a risky debt-fueled rally since 2020. In Rickards' view, the looming recession has all the hallmarks of a long, slow slide, driven by persistent inflation, rising costs of living, and the deflating of asset bubbles. Rather than a single catastrophic event, he sees a prolonged slump as the most likely scenario. This progressive downturn could see GDP contract, while unemployment ticks steadily upward throughout 2023 and beyond. The Fed's aggressive monetary tightening may also trigger a harsh recession, as it slams on the brakes on credit flows. Critics argue that the Fed missed its opportunity to gradually normalize policy once the recovery was underway. Now, the central bank must choose between high inflation and recessionary pain. Given the threat of stagflation, an economic contraction is arguably the lesser evil. Geopolitical strife is yet another recessionary indicator on the horizon. Russia's invasion of Ukraine triggered commodity supply disruptions that will continue depressing global growth, and simmering tensions between the US and China carry the threat of greater trade and financial fragmentation that could usher in a new era of deglobalization, disrupting multinational firms worldwide. In essence, Rickards sees the conditions ripening for a recession vortex throughout 2023. The weakening dollar is the linchpin that will unsettle markets and consumer sentiment. But multiple forces such as tight money, inflated assets, geopolitics, policy errors all orbit around this core dollar crisis, reinforcing the downdraft. While mainstream economists expect a mild recession, Rickards warns they will underestimate the systematic risks posed by the dollar's waning dominance. Most analyses downplay or outright ignore this monetary angle. But, in Rickards' view, the global currency turmoil will magnify the downturn far beyond consensus estimates, making the 2023 recession among the most impactful in modern times. So, how can everyday Americans prudently navigate these treacherous waters ahead? Thankfully, Rickards provides a life raft, strategic diversification into these two assets, designed to weather currency crisis and thrive when other markets teeter. Gold and silver in particular have historically served as safe haven assets during periods of geopolitical strife and economic recession. Gold has historically been a premier safe haven asset during times of market turmoil and economic crises. This is evidenced by gold's performance during the 1970s stagflation era, when its price rose over 2,300%. More recently, gold prices increased by 28% during the 2008-2009 financial crisis. Gold thrives in these conditions because investors flock to its enduring status as a store of value amid currency debasement fears. For example, during the 1970s, inflation rampaged, severely eroding the US dollar's purchasing power. Gold provided a hedge as its price advanced in lockstep with rising consumer prices. Today, with inflation at 40-year highs and a potential global recession looming, gold's inflation hedging properties make it an attractive investment once again for those seeking shelter from depreciating currencies. Gold also provides portfolio diversification due to its low to negative correlation with stocks and bonds. During the first half of 2022, bonds lost over 10%, while gold prices were essentially flat. This diversification helps explain why central banks boosted net gold purchases to the highest levels on record last year. In a recession scenario with declining stock markets, gold's portfolio diversification benefits become even more pronounced. Its ability to mitigate losses and volatility in a market downturn enhances gold's recession-proof appeal. On the other hand, silver has demonstrated similar safe haven properties, but offers additional upside potential from industrial demand. For example, silver jumped 139% in 1980, when prices last peaked amid double-digit inflation. And in 2020, its price soared 47% on its dual role as a monetary and industrial metal. But silver can be more volatile. While gold rose 25% during the Great Recession, silver spiked over 90% at its peak. This leverage gives silver more pronounced upside, albeit with higher short-term risk. But over long periods, silver has significantly outperformed stocks, making it compelling for investors worried about deep equity downturns. From 1970 to 2022, silver gained over 3,800%, while the S&P 500 advanced under 2,900%, given silver's historic ability to thrive during major equity bear markets. Adding some exposure could help hedge recession risks. In troubled times like these, the most prudent strategy is to hope for the best, but prepare for the worst. Heeding Rickards' wisdom, Investors can pivot towards assets that historically prevail through periods of economic contraction. Gold and silver. These two assets can position savvy Americans to endure and overcome whatever economic storms 2023 may bring. Though the forecast may seem dire, opportunity lives on the other side of adversity. Winter's chill gives way to springtime renewal. By taking pragmatic steps to reinforce our financial foundations today, we can emerge stronger for the future. The winds of change are upon us, but it is not the end. It is simply the beginning of a new economic cycle. Winter comes before the thaw. Stay the course, stay tuned, and prosperity awaits on the horizon. Thank you for joining us today. If you found this video helpful, make sure to like and subscribe to our channel to catch all of our upcoming investment content. Until next time, stay money-wise.